Understanding banking, differentiating banks, and choosing the right bank for you. What is a bank? A bank is a type of financial institution authorized to grant loans and take deposits for checking and savings accounts. Individual retirement accounts, or IRAs, certificates of deposit or CDs, currency exchange, and safe deposit boxes are other services that banks offer. Retail banks, commercial or corporate banks, and investment banks are just a few of the several sorts of banks. In the United States, banks are subject to both federal and state regulation. Understanding banks? Since the 14th century, at least, banks have existed. They give customers and company owners a secure location to store their cash as well as a way to get loans for both personal and professional endeavors. Banks provide loans and charge interest on them using the money that is deposited. Since the Medici family began dabbling in banking during the Renaissance, the core business model hasn't altered much, but the variety of goods that banks provide has expanded. Checking accounts? Consumers and companies utilize checking accounts as deposits to pay their bills and withdraw cash. They often come with monthly fees, use fees, or both and pay little to no interest. Most modern customers have one of these accounts regularly credited with their wages and other recurring payments. Savings accounts? Savings accounts reward the depositor with interest. Account holders can open a certificate of deposit or CD, which pays somewhat higher interest, or a conventional savings account, which pays minimal interest, depending on how long they want to keep their money in the bank. The CDs might generate interest for a few months or for 5 years or more. It is crucial to remember that the federal government, through the Federal Deposit Insurance Corporation, insures the funds in checking accounts, savings accounts, and CDs up to a limit of $250,000 in value, FDIC. Loan services? Banks lend money to both individuals and companies. Their clients deposit cash, which is then lent to more customers at a greater interest rate than the depositor is paid. At its core, this procedure is what keeps the economy growing. People deposit money in banks, and the banks lend it out in the form of business loans, mortgages, credit cards, and auto loans. The method keeps money flowing through the system as the loan recipients use the money they borrow and the bank makes interest on the loans. A bank's objective, like that of any other company, is to generate a profit for its shareholders. The majority of banks' shareholders serve as their owners. Banks do this by charging borrowers for loans and other debt at a higher rate of interest than they do for those who utilize their savings accounts. For instance, a bank may charge 6% interest on home loans while paying 1% interest on savings accounts, resulting in a 5% gross profit for the bank's shareholders. By charging higher interest on loans than they do on savings accounts, banks generate a profit. Brick-and-mortar and online banks? Small, locally based organizations up to large, international commercial banks make up the banking industry. In the United States as of 2021, there were little over 4,200 commercial banks that were FDIC insured. National banks, commercial banks, state-chartered banks, and other financial institutions are all included in this total. Traditional banks today provide both online services and physical branch sites. In the early 2010s, online-only banks started to appear. Customers select a bank based on a variety of criteria, including interest rates, fees, and geographical convenience. How are banks regulated? After the 2008 global financial crisis, U.S. banks came under increasing scrutiny. As a result, the regulatory environment for banks was significantly strengthened. U.S. banks may be subject to state, federal, or both levels of regulation, depending on their organizational structures. Each state's Department of Banking or Department of Financial Institutions oversees the regulation of state banks. This organization is typically in charge of things like allowed practices, the maximum interest rate a bank may charge, and auditing and inspecting banks. Office of the Comptroller of the Currency oversees national banks, or OCC. OCC rules mainly deal with the capitalization rates, asset quality, and liquidity of banks. As mentioned above, the FDIC also controls institutions that have FDIC protection. Following the financial crisis, the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010 with the goal of lowering risks in the American financial system. Large banks are now subject to recurring examinations to see if they have enough capital to continue functioning in uncertain economic times. The term stress test refers to this yearly evaluation. Types of banks. The majority of banks fall into one of three categories: investment, commercial, or retail. For each of these categories, the large international banks frequently run distinct arms. Retail banks. Retail banks provide services to the general public and typically have branch locations in addition to their main locations for the benefit of their clients. Numerous services are offered by them, including checking and savings accounts, loan and mortgage services, vehicle finance, and short-term loans like overdraft protection. Several also provide credit cards. Additionally, they provide access to assets through mutual funds, individual retirement accounts, and CDs, IRAs. The largest retail banks also provide high-net-worth clients specialized services including wealth management and private banking. TD Bank and Citibank are two instances of retail banks. Corporate or commercial banks. Commercial or corporate banks customize their services for business clients, ranging from sole proprietors to major corporations. These banks provide trade financing, cash management, commercial real estate services, credit services, and employer services in addition to regular business banking. JP Morgan Chase and Bank of America are examples of commercial banks, however both have major retail banking departments as well. Investment banks. Investment banks are primarily focused on offering complicated services and financial transactions to corporate clients, such as underwriting and aiding in merger and acquisition (M&A) activities. In these deals, they serve largely as financial mediators. Large enterprises, other financial institutions, pension funds, governments, and hedge funds are just a few of their clientele. Among the largest investment banks in the United States are Morgan Stanley and Goldman Sachs. Central banks. The public is not directly served by central banks, in contrast to the banks mentioned above. A central bank is an autonomous organization that has been given permission by the government to manage the country's monetary policy and money supply. As a result, central banks are in charge of maintaining the currencies and the economy's overall stability. Additionally, they play a part in governing the capital and reserve requirements for the country's banks. The Central Bank of the United States is the U.S. Federal Reserve Bank. Among its international counterparts are the People's Bank of China, the European Central Bank, the Bank of England, the Bank of Japan, the Swiss National Bank, and the Bank of England. Bank versus credit union? Although credit unions provide banking services, they are not-for-profit organizations founded by and operated for the benefit of its members or consumers, as opposed to banks. Regular banking services are offered by credit unions to its members, who are typically their consumers. Credit unions are often tax-exempt organizations that are founded, owned, and run by their members. Shares in the cooperative are purchased by members, and the proceeds are used to support loans made by the credit union. When compared to banks, they frequently provide a smaller selection of services. Additionally, they have fewer outlets and ATMs. How do I know my money is safe in a bank? For the purpose of preserving stability and public trust in the American financial system, Congress established the Federal Deposit Insurance Corporation, FDIC, an independent organization. To guarantee that the money banks handle is secure, the FDIC monitors and audits them. It also insures your financial assets. For each type of account ownership, the insurance maximum is $250,000 per depositor, per insured bank. You are not required to get this insurance. You are automatically covered when you open a deposit at a bank that is FDIC insured. You may locate banks and branches that are FDIC insured via the organization's BankFind website. At the very least, a bank is where you stash your cash until you use it to pay the bills or withdraw money. It can also be the place where you get a loan to buy a car or a mortgage to buy a house. If you're running a small business, it may be where you go to borrow money to expand or improve. Before choosing a bank, you should make a comparison of the various fees and charges that come with your accounts or any loans you might need. A bit of research and comparison will ensure you find the right fit for safeguarding your money, establishing credit, making payments, applying for loans, receiving funds, and saving money for future needs such as retirement, emergencies, and home buying. Thank you for watching. Please like, share, and subscribe.